Welcome to Module 5, the home stretch of your home buying journey. If the previous modules were like planning a wedding, then Module 5 is like the actual wedding day. Exciting, slightly terrifying, and full of details that need to come together perfectly for everything to work out. You found your house, made an offer, and had it accepted. Congratulations. But don't start packing yet, because now comes a period where everything gets very real very quickly. This is where we make sure the house is actually worth what you're paying for it, that it won't fall down next week, and that your lender still thinks you're a good risk. By the end of this module, you'll know exactly what to expect during the home inspection and how to handle any issues that come up. You'll understand the final steps of the mortgage process and how to avoid last-minute surprises. You'll know what all those closing costs are actually for, and you'll be prepared for closing day itself. This is where all your preparation pays off and you finally get a hold of those keys in your hand. So, let's walk through everything that happens between congratulations, your offer was accepted, and congratulations, you're a homeowner. Time to bring this baby home. The home inspection process. Let's start with the home inspection, which is basically like getting a physical exam for your house. Just like you wouldn't buy a used car without having a mechanic look at it, you shouldn't buy a house without having a professional inspector check it out. The difference is, if your car breaks down, you're stranded. If your house has major problems, you're broke. House inspectors are like house detectives. They're trained to find problems that aren't obvious to the average person. They'll check major systems, electrical, plumbing, heating and cooling, roof, foundation, as well as things like windows, doors, insulation, and overall structural integrity. A typical inspection takes 2 to 4 hours depending on the size and age of the house. You should absolutely attend the inspection if possible. This isn't about just getting a report later, it's about learning about your future home and understanding any issues firsthand. Here's what inspectors look for, and trust me, they're thorough. They'll check the electrical system to make sure it's safe and up to code. Old houses might have outdated wiring that's not just inefficient, but actually dangerous. They'll test outlets, check the electrical panel, and look for any fire hazards. They'll examine the plumbing system, checking for leaks, water pressure issues, and proper drainage. They'll run water in all the sinks, flush all the toilets, and check the water heater. Plumbing problems can be expensive to fix and cause ongoing issues, so this is crucial. The heating and cooling systems get a thorough check. They'll test the furnace, air conditioning, ductwork, and ventilation. HVAC systems are expensive to replace, and you'll want to know if you're looking at a major expense in the near future. The roof and exterior get careful attention. They'll look for damaged shingles, signs of leaks, problems with gutters, and issues with siding or brick. A roof replacement can cost tens of thousands of dollars, so you definitely want to know about any problems before you buy. They'll check the foundation and overall structural integrity. This includes looking for cracks, settling issues, or signs of water damage in basements or crawl spaces. Foundation problems can be extremely expensive and affect the entire house. Windows and doors get tested for proper operation and energy efficiency. They'll check for broken seals and double pane windows, which can affect both comfort and energy costs. The inspector will also look for safety issues like missing handrails, trip hazards, or improperly installed smoke detectors. These might seem minor, but they're important for your safety and might be required fixes. They'll check for signs of pests or previous pests, termites, carpenter ants, or other pests that can cause significant structural damage that's expensive to repair. Now, here's how to evaluate inspection reports, because not all problems are created equal. The inspector will typically categorize issues as major, minor, or safety concerns. Major issues are things that can be expensive to fix and affect the livability of the house. Minor issues are cosmetic or maintenance items that aren't urgent. Safety concerns should be addressed immediately, things like electrical hazards, gas leaks, or structural problems that could be dangerous. When you get the inspection report, don't panic. If it's 20 pages long with lots of issues listed, every house, even new construction, will have some problems. The question is whether the problems are deal breakers, negotiation opportunities, or just things to be aware of for future maintenance. Focus on the big ticket items first. A roof that needs replacement in the next year or two is much more significant than a dripping faucet. Major electrical or plumbing issues can cost thousands of dollars to fix and might indicate other hidden problems. Consider the age and overall condition of major systems. If the furnace is 20 years old but functioning fine, you might just want to budget for a replacement in the next few years. If it's failing now, that's a more immediate concern. Think about what you're capable of handling yourself versus what requires professional help. If you're handy and enjoy home improvement projects, minor issues might not bother you. If you have no interest in fixing anything, even small problems might be concerning. Now let's talk about negotiating repairs versus credits, because you have options when the inspection reveals problems. You can ask the seller to fix the issues before closing, ask for a credit at closing to cover the cost of repairs, or ask for a reduction in the purchase price. Each approach has pros and cons. If you ask the seller to make repairs, you don't have to come up with additional cash, but you have no control over the quality of the work. Sellers might hire the cheapest contractors or do minimal fixes rather than comprehensive repairs. If you ask for credits or price reductions, you have control over how the repairs are done, but you need additional cash to pay for them. You also take on the hassle of coordinating repairs after you move in. For major issues, price reductions or credits are often better because you can ensure the work is done properly. For minor issues, asking the seller to fix them might be simpler. Consider the seller's situation too. If they're highly motivated to sell quickly, they might prefer to give you a credit rather than delaying closing to make repairs. If they have time and want to maintain the house's condition, they might prefer to fix things themselves. When negotiating, be reasonable. Don't ask the seller to fix every minor issue in the inspection report. Focus on significant problems and safety concerns. Remember, you're buying a used house, not a new one, so some wear and tear is normal. Here's when to walk away from a house based on the inspection results. Major structural problems like foundation issues, roof problems that require complete replacement, or electrical systems that need to be completely rewired might be deal breakers, especially if the costs are more than you can handle. Serious safety issues that can't be easily fixed should also be red flags. If the inspection reveals problems that suggest the house hasn't been properly maintained, there might be other hidden issues you haven't discovered yet. If the total cost of the needed repairs exceeds your budget for improvements, or if the seller refuses to negotiate on significant issues, it might be time to walk away. Sometimes the right decision is to find a different house rather than taking on more problems than you can handle. Environmental issues like asbestos, lead paint, or mold can be expensive to remediate and might affect your health. Depending on the extent of these problems, they might be deal breakers. Remember, your inspection contingency gives you the right to walk away if you're not satisfied with the condition of the house. It's better to lose your inspection fee and find a different house than to buy a money pit that will drain your finances for years. The key is keeping perspective. Every house will have some issues, but you want to make sure that you're not taking on more problems than you bargained for. A good inspection helps you make an informed decision about whether this house is really the right choice for you. Finalizing your mortgage. Now let's talk about finalizing your mortgage, which is like the final exam after months of studying. You've been pre-approved, you have a house under contract, and now your lender needs to make sure everything still adds up before they actually give you hundreds of thousands of dollars. This is where you'll submit your final documentation to the lender. Even though you provided most of these documents during pre-approval, the lender will want updated versions and additional information specific to the house you're buying. You'll need to update pay stubs, typically from the last 30 days. If you got a raise or your income changed since pre-approval, you'll need to document the change. Any gaps in employment or changes to your job situation will need to be explained. You'll need updated bank statements, usually the most recent 2 months. The lender will scrutinize these for any large deposits or unusual transactions during the look-back period we talked about in Module 3. You'll need the purchase contract and any amendments or addendums. The lender needs to see exactly what you're buying and for how much. You'll need homeowner's insurance information. Before closing, you'll need to have the insurance in place and provide proof to the lender. The insurance amount must be sufficient to cover the loan amount, and the lender must be listed as the mortgagee. If you're buying a condo, you'll need information about the homeowners association, including HOA fees, master insurance coverage, and possibly HOA financial statements. Now, let's talk about the underwriting process, which is where a human being at the lender's office actually reviews your file and decides whether to approve your loan. Think of the underwriter as the final boss in a video game. They have the power to approve or deny your loan, and they're going to check everything thoroughly. The underwriter will verify your income, employment, assets, and debts. They'll look at the appraisal to make sure that the house is worth what you're paying for it. They'll review the inspection report and any repair negotiations to understand the condition of the property. They might ask for additional documentation or clarification on items in your file. This is normal, not a sign that anything is wrong. Common requests include letters of explanation for credit inquiries, proof of the source of funds for your down payment, or verification of employment closer to closing. The underwriter will issue one of 3 decisions: clear to close, conditional approval, or denial. Clear to close means you're approved and can proceed to closing. Conditional approval means you're approved but need to satisfy certain conditions first. And denial means the loan is not approved. If you get conditional approval, don't panic. This is actually very common. The conditions might be simple things like providing an updated pay stub or proof that you've obtained homeowner's insurance. More complex conditions might require additional documentation or explanations. Work with your lender to satisfy any conditions as quickly as possible. The faster you provide what they need, the faster you can get to closing. Don't ignore requests for additional information. The underwriter can't approve your loan without everything they need. Here are actions that could derail your loan approval, and I want you to pay close attention to this because I've seen people lose their dream homes by making silly mistakes during this critical process. Don't make any major purchases. This includes cars, furniture, appliances, or anything else that requires financing or significantly reduces your cash reserves. That new car can wait until after you close on your house. Don't open new credit accounts. This includes credit cards, store cards, or any other new credit. Even applying for new credit can lower your credit score and raise questions with the underwriter. Don't close existing credit accounts. This can actually hurt your credit score by reducing your available credit and potentially shortening your credit history. Don't make large deposits without documenting the source. If you receive money from any source, make sure you can explain where it came from and provide documentation if needed. Don't change banks or move money between accounts unnecessarily. If you do need to move money, keep documentation of the transfers. Don't change jobs unless absolutely necessary. If you do change jobs, notify your lender immediately. A job change doesn't automatically disqualify you, but it needs to be documented and might delay your closing. Don't co-sign for anyone else's loans or credit accounts. This adds to your debt obligations and changes your debt-to-income ratios. Don't ignore requests from your lender. If they ask for additional documentation or information, provide it as quickly as possible. Delays in responding can delay your closing. The key during this period is to keep your financial situation as stable as possible. Pretend your lender is watching every financial move you make because they basically are. If anything changes in your financial situation, you get a bonus, lose income, have unexpected expenses, or anything else significant, communicate with your lender immediately. It's much better to address potential issues early than to have surprises pop up right before closing. Most loan conditions can be resolved without major problems, but it requires staying organized and responsive. Keep copies of everything you submit to the lender. Follow up to make sure they received your documents, and don't hesitate to ask questions if you don't understand what they're requesting. Remember, your lender wants to approve your loan as much as you want it approved. They've already invested time and money in processing your application, and they only make money if the loan closes. But they also have to follow regulations and ensure the loan meets all requirements. The final loan approval process typically takes 1 to 2 weeks after you submit all the required documentation, though it can be faster or slower depending on the complexity of your situation and the lender's current volume. Once you get final approval, you're cleared to close, which means you can schedule your closing date and start planning your move. But even after final approval, continue to avoid major financial changes until after you've signed all the closing documents and received your keys. Closing costs breakdown. Now let's talk about closing costs, which are like the hidden fees of home buying. Just when you think you've budgeted for everything, you discover there are dozens of additional costs to actually complete the purchase. It's like buying a concert ticket and then finding out about the service fees, convenience fees, processing fees, and a fee for the privilege of paying the other fees. Closing costs typically range from 2 to 5% of the loan amount, though they can be higher in some areas or situations. On a $300,000 loan, that's $6,000 to $15,000, which is real money that you need to budget for in addition to your down payment. Let's break down what you're actually paying for because some of these fees have names that give you no clue what they're for. It's like trying to decode your cell phone bill except with more zeros. First, let's talk about lender fees. The origination fee is what the lender charges for processing your loan. This is typically 1% of the loan amount, though some lenders charge less or roll this into a slightly higher interest rate. The application fee covers the cost of processing your loan application. Some lenders charge this up front, others roll it into the closing costs. The underwriting fee is what you pay for having a human actually review and approve your loan. In the age of automation, having someone actually look at your file apparently costs extra. You'll pay for the appraisal, which determines the market value of the house. This typically costs $300 to $600 depending on the size and complexity of the property. The credit report fee covers the cost of pulling your credit report. Even though you can get the same information for free, it's usually less than $50, but still annoying. Now, let's talk about third-party fees, which are costs for services provided by people other than your lender. The title search fee covers the cost of researching your property's ownership history to make sure the seller actually owns it and has the right to sell it. You'd think this would be obvious, but apparently it's not. Title insurance protects you and the lender if there are problems with the title that weren't discovered during the title search. There are actually two policies, one that protects the lender and one that protects you. The lender's policy is required. Your policy is optional but recommended. The survey fee pays for having the property's boundaries professionally measured and marked. This ensures you know exactly what you're buying and that the buildings aren't encroaching on neighboring properties. Home inspection fees cover the cost of having the house professionally inspected. This is money well spent, even though it adds to your closing costs. Attorney's fees vary by state. In some states, you're required to have an attorney handle the closing. In others, a title company can handle everything. If you need an attorney, expect to pay $500 to $1,500. Government fees include things like recording fees to officially record the deed of mortgage with the county, transfer taxes in some jurisdictions, and other local fees that vary by location. Prepaid costs are expenses that you pay up front to set up your mortgage account. Property taxes are typically collected monthly with your mortgage payment and held in an escrow account. At closing, you'll prepay several months of property taxes to establish this account. Homeowners insurance works the same way. You'll pay the first year's premium plus additional months to fund the escrow account. If you're getting an FHA loan, you'll pay the upfront mortgage insurance premium at closing. For conventional loans with PMI, you might pay the first month's premium or more at closing. Interest on your mortgage is paid in arrears, meaning your first payment covers interest for the previous month, but you'll pay interest from your closing date to the end of the month at closing. If you close early in the month, this can be a significant amount. Now let's talk about how to estimate your closing costs, because you need to plan for these expenses when budgeting for your home purchase. Your lender is required to provide a loan estimate within 3 business days of your application, which includes an estimate of your closing costs. The loan estimate breaks costs into categories: origination charges, services that you cannot shop for, services that you can shop for, taxes and government fees, and prepaids. This makes it easier to understand what you're paying for and which costs you might be able to reduce. Some costs are the same regardless of which lender you choose. Things like appraisal fees, title insurance, and government fees are pretty standard. Other costs, like origination fees and some third-party services, can vary significantly between lenders. You can shop around for some services like homeowners insurance, title insurance in some states, and attorneys. Getting quotes from multiple providers can potentially save you money. Your real estate agent can often recommend service providers who are reliable and competitively priced. They work with these vendors regularly and know who provides good services at fair prices. Here's how negotiating seller concessions work. Seller concessions are when the seller agrees to pay some or all of your closing costs. This can be a great way to reduce the cash you need to bring to closing, though there are limits on how much sellers can contribute. For conventional loans, seller concessions are typically limited to 3% of the sale price for buyers putting down less than 10%, 6% for buyers putting down 10 to 25%, and 9% for buyers putting down more than 25%. FHA loans allow seller concessions up to 6% of the sale price. VA loans allow up to 4%. These limits are designed to prevent buyers from inflating the purchase price to cover closing costs. Seller concessions can cover most closing costs, but they can't be used for your down payment. The seller can pay for things like origination fees, appraisal costs, title insurance, and prepaid items, but you still need to come up with your own down payment from your own funds. When negotiating seller concessions, remember that you're essentially asking the seller to accept a lower net price for their house. If you offer $300,000 with $5,000 in seller concessions, the seller is really only getting $295,000. In competitive markets, asking for seller concessions might make your offer less attractive. In buyers' markets, sellers might be more willing to pay closing costs to get their house sold. You can also ask for specific closing cost items rather than a dollar amount. For example, you might ask the seller to pay for the appraisal and title insurance rather than asking for $3,000 in concessions. Some sellers prefer to offer concessions rather than reduce the purchase price because it affects the appraisal differently. A house that sells for $300,000 with seller concessions might appraise for more than a house that sells for $295,000 without concessions. The key is understanding that closing costs are negotiable and there are strategies to reduce the cash you need to bring to closing. But you need to factor these costs into your overall budget from the beginning because they're not optional. Somebody has to pay them for the transaction to close. Plan for the high end of the estimated range when budgeting because closing costs can sometimes be higher than initially estimated. It's better to have extra money that you don't need than to be scrambling to find additional funds before closing. The closing day process. Welcome to the closing day, the finish line of your home buying marathon. This is the day when all the paperwork gets signed, money changes hands, and you finally get those keys you've been dreaming about. It's exciting, overwhelming, and usually involves signing your name more times than when you were practicing your signature in middle school. Let's start with what to expect at closing, because knowing what's coming helps reduce the stress of an already stressful day. Closing typically takes 1 to 2 hours, though it can be longer if there are complications or if you're the type of person who reads every single page of the documents you're signing, which is a good thing. You'll be sitting at a table with several other people: the closing agent or attorney who's conducting the closing, your real estate agent, the seller and their agent, and possibly a representative from your lender. In some areas, buyers and sellers close separately, so you might not actually meet the people you're buying from. The closing agent will walk you through each document, explaining what you're signing and why. Don't feel pressured to rush through this process. You're making one of the biggest financial commitments of your life, so take the time you need to understand what you're agreeing to. Now let's talk about the documents you'll sign, and trust me, there are a lot of them. You'll sign enough papers to keep a small timber mill in business, but each document serves a specific purpose in transferring ownership and setting up your mortgage. The mortgage note is your IOU to the lender. This document states how much you're borrowing, the interest rate, the repayment terms, and what happens if you don't make your payments. This is the document that makes you legally obligated to repay the loan. The mortgage or deed of trust secures the loan with the property. This gives the lender the right to foreclose if you don't make your payments. It's like the collateral agreement for your loan. The deed transfers ownership of the property from the seller to you. There are different types of deeds, but they all accomplish the same basic function, making you the legal owner of the house. You'll sign a closing disclosure, which is the final statement of all the loan terms and closing costs. This should match the loan estimate you received earlier, though some costs might have changed slightly. The truth in lending disclosure explains the terms of your loan in standardized language required by federal law. This includes the APR, the finance charges, and the total amount you'll pay over the life of the loan. You'll sign various affidavits and declarations, including statements that you intend to occupy the property as your primary residence if this is a primary residence loan, that you haven't taken on any new debt since your loan was approved, and any other legal certifications. There will be documents related to escrow if your lender is collecting property taxes and insurance with your monthly payment. These explain how the escrow account works and your rights related to escrow. If your loan includes mortgage insurance, you'll sign disclosures explaining when and how the insurance can be canceled. You might sign documents related to the property, such as acknowledgments that you've received certain disclosures about environmental hazards, lead paint, or other property-specific issues. The final walkthrough checklist is something that you should do before closing, ideally within 24 hours of the closing appointment. This is your last chance to make sure the house is in the condition you agreed to purchase it in. During the final walkthrough, check that any repairs negotiated after the inspection have been completed. If the seller agreed to fix the leaky faucet, make sure it's actually fixed, not just temporarily stopped with duct tape. Make sure all the systems are working, turn on the lights, run the water, test the heating and cooling system, and check that appliances included in the sale are present and functioning. Look for any new damage that might have occurred since your last visit. Moving trucks can be hard on walls and floors, and you want to identify any problems before you take ownership. Verify that the seller has removed all of their belongings and cleaned the house according to your agreement. If the contract specified that the house would be delivered broom clean, make sure it actually is. Check that any items included in the sale are still there: appliances, light fixtures, window treatments, or other items specifically mentioned in the contract. If you find problems during the final walkthrough, don't panic, but don't ignore them either. Minor issues can often be resolved with a credit at closing. Major problems might require delaying the closing until they're fixed. Now let's talk about bringing funds to closing, because you can't just show up with a personal check for $50,000. Large amounts of money require specific forms of payment for security and legal reasons. You'll need a cashier's check or a wire transfer for your down payment and closing costs. Personal checks usually aren't accepted for large amounts because they can bounce, and nobody wants to discover that your down payment check didn't clear after you've already moved in. The exact amount you need to bring will be specified on your closing disclosure, which you should receive at least 3 business days before closing. This gives you time to arrange for the funds and ask questions about any unexpected costs. If you're using wire transferring funds, make sure you have the correct wiring instructions from the closing agent. Wire fraud is unfortunately common in real estate transactions, so verify all wiring instructions by phone before sending money. You'll also need to bring a photo ID, driver's license or passport to verify your identity. You might need multiple forms of ID if your name appears differently on various documents. Bring your homeowner's insurance policy declarations page or other proof that you have insurance coverage starting on the closing date. If you're married and buying a house jointly, both spouses typically need to be present in closing, even if only one person is on the mortgage. What happens after you sign all the documents? The closing agent will collect all the signed paperwork and ensure the funds are properly distributed. The seller gets paid, the real estate agents get their commissions, and various service providers get paid for their services. The deed and mortgage documents get recorded with the appropriate government office, which makes your ownership and the lender's lien a matter of public record. This usually happens within a few days of closing. You'll receive copies of all the important documents, usually in a folder or binder. Keep these documents safe. You'll need them for tax purposes and if you ever sell or refinance the house. Most importantly, you'll get the keys to your new home. This is the moment you've been working toward through all these modules. So congratulations, you're now a homeowner. After closing, there are a few immediate tasks to take care of. Make sure utilities are transferred to your name and scheduled to be turned on. There's nothing quite like moving into a house with no electricity or water. Change the locks or rekey the existing locks. You don't know who might have keys to your house from previous owners, contractors, real estate agents, family members. Locate the main water shutoff valve and electrical panel just in case you need them in an emergency. If you have a garage door opener or security system, make sure you know how to operate them and change any access codes. Take videos or photos of the house's condition on move-in day. This documentation can be helpful for insurance purposes if you ever need to file a claim. The closing process can feel overwhelming, but remember that the closing agent is there to guide you through everything. Don't hesitate to ask questions if you don't understand something. It's better to take extra time at closing than to discover later that you misunderstood an important term of your mortgage or ownership. Wrap up. Congratulations, you've just completed the final module of your home buying journey, which means you now understand everything that happens from getting an accepted offer to actually owning your own home. You now know how to navigate the inspection process, negotiate repairs, how to finalize your mortgage without derailing your approval, what all those closing costs are actually for, and what to expect on closing day itself. More importantly, you've completed the entire home buying education that most people never get. You understand the process from start to finish. You know how to avoid the common mistakes that trip up other first-time homebuyers, and you're prepared to make informed decisions at every step. Here's what you should do now. If you haven't started your home buying process yet, use this knowledge to create a timeline and action plan. Start with getting your finances in order, then move through each step systematically. If you're already in the middle of the process, review the modules that apply to your current stage and make sure you haven't missed anything important. Remember, buying your first home is a big step, but it's not as mysterious or impossible as it might have seemed when you started this course. You now have the knowledge and tools to navigate the process successfully. The most important thing to remember is that this is your expedition and your decision. Don't let anyone pressure you into buying a house you're not comfortable with or taking on more debt than you can handle. The right house at the right price with the right terms will come along. Homeownership is one of the most rewarding experiences you can have, but it's also a major responsibility. Take care of your investment, stay on top of maintenance, and enjoy the pride and security that comes with owning your own home. Congratulations on completing this course, and best of luck with your home buying expedition. I hope you find the house of your dreams and the experience you deserve.